How bad is it? Mexico is stellar performer even there. Peso off the high is a weaker 8%.
Well, I think what's happening right now is actually the dollar has reemerged again. There's been a huge amount of upside surprises from a U.S. economy perspective, and that's giving a bid to the dollar. Additionally, you have geopolitics, and people are buying dollars as a safe haven. So the combination of those two is taking off some of the shine in emerging market currencies that we'd seen up until the summer.
Stan Fisher wrote that little red book everybody was forced to read. I think it was 1999, 1 year after 1998. Mm-hmm. Are we anywhere near the instabilities of a given crisis in Ecuador, a crisis in Mexico for that matter, or a crisis in Southeast Asia? What's the level of instability you perceive in EM?
Much less than during COVID, because I think a lot of the vulnerabilities were addressed during that period. The insolvent economies are already talking to the IMF, and I'm sure you had a lot of that in Morocco. The IMF is...
Don't ask about Argentina. Okay, continue.
The IMF is standing ready to support economies. So we don't necessarily think in the next 1 to 2 years we are likely to see anything. There's maybe 1 or 2 credits that look vulnerable, that have maturities coming. But broadly speaking, I think EM should be able to muddle through.
In 30 years' time, will we have a restructuring plan for the United States of America? Is that where things are going? Where's this headed? Where is this going? When you speak to emerging market nations, how are they thinking about what's taking place in America? For all the preaching they've heard about how they should manage their finances, what are they saying about this in Washington?
Well, they've clearly lost the handle on fiscal in the US. It feels like whatever is happening, whether it's political impasse, the answer is let's spend some more. When it's geopolitics, the answer is let's spend some more. And you've lost your price-insensitive buyer. We had the QE that was supporting this. Now the markets have to figure out how much premium you need to be if you expect more issuance to come forward.
Yeah, moments ago, Lisa, Damian Sasso are out watching this, and he makes clear he agrees with Diana. He sees quality reserves at EM.
Right. What does quality mean at a time where you've got a Treasury yield that is going up and away? Diana, I do want to just sort of put a bow on that point. Are you saying that we have seen the reaction function to weakness? We have seen the reaction function amid a search for safe havens, and Treasuries no longer get that bid in a reliable way?
Well, they got the bid when we had the geopolitics headlines a couple of weeks ago. You saw the move in Treasuries, which rallied as people still saw them as a safe haven. But despite that ongoing, as soon as we had a bit of stability, markets were quick to unload these Treasuries. Because what are we hearing? There's another 100 billion potentially that's going to be spent to support these economies, and markets simply don't have the appetite.
Do you think that this pain will be reserved to the U.S. government debt market? Or is it the kind of theory where when the U.S. catches a cold, the rest of the developing world catches a flu?
Well, I think there's 2 big elephants in the room, the U.S. and the BOJ, where sovereign debt issues or sustainability have been a concern, but more of a slow-burning concern for a while. Now, while these are playing out, I think they will tend to take everything with them, but it's the speed of the move that matters, and we've had a pretty aggressive move in Treasuries. So if, going forward, we say maybe Treasuries can go from 4.5 to 5.5, but we're not necessarily going to see that happening in a 6-week period. I think markets can handle that.
Where can we hide? Where can we hide in EM?
You know what I'm going to say? Emerging markets. You're actually getting paid to do the work now in EM. EM high yield yielding north of 10%, EM IG yielding north of 6%. Looks like an interesting space. That said, it's not a one-size-fits-all. Tom mentioned Argentina. We still have cases like that look very vulnerable. I think this is a period where if you do your bottom-up security analysis and you know the stories that you're buying really well, there's a lot of opportunities in emerging markets.
What about Turkey? Fascinating leadership shift taking place in that country. What is going on?
I mean, it's like a total... We had the same outcome in the elections, but it's like a totally different leadership.
It's amazing.
Yeah, so they've embraced orthodox policies now. They're speaking the market talk, and markets are responding well to that. We've seen aggressive rate hikes and a commitment to actually fight inflation, which is refreshing to see.
When you talk about developing markets, I have to think about what's going on right now, excuse me, in the Middle East, and just wonder how closely you're following this as a potential, not only humanitarian and a question around what's going to happen and how wide the conflagration goes, but what this means for the ability to invest in some of these nations.
Well, it's clearly a sad turn of events, and we're obviously following it very closely. I think what the big concern is, beyond the humanitarian cost of lives, is what does this actually mean for, one, the region, stability within the broader region? Are we going to see spillover effects in the Middle East? Are other countries going to get pulled into this? And you've seen actually markets repricing. You've seen CDS in some of these Middle Eastern economies actually move quite high because markets are assigning a premium that it's a non-insignificant risk that you could see spillover risks coming in. And I think broadly speaking, beyond the Middle East, it's oil prices obviously is the next big one, because you have this potential supply side shock, and that could actually make monetary policy much trickier going forward if you see inflation starting to pick up again.